Welcome to the deep dive. If you're tracking the health of logistics and industrial real estate across North America, you really have to be watching the Indianapolis market.
Oh, absolutely.
It is, without a doubt, the definitive bellwether for the entire Midwest logistics network.
That's so right. Indy is where you see these huge national trends. I'm talking supply surges, capital cost pressures, the race to automate. It all seems to happen there first.
And it gets resolved there first.
Exactly. So our mission today is, well, it's highly strategic. We are analyzing the pivot that you need to make for success in the Indianapolis industrial market, specifically starting in 2026.
Okay, so let's set the stage. We know 2024 was defined by, just a massive supply surge. Developers delivered a huge amount of space.
And predictably, that led to some elevated vacancy rates across the board.
Right. But that environment, the one that really favored buyers and tenants,
It's dissolving.
Yeah.
And fast. I think the biggest takeaway you need from this deep dive is all about timing. 2026, that's the beginning of the decisive recovery phase.
so the window for those buyer-favorable deals.
It's closing rapidly. Market leverage is decisively shifting back toward sellers. So if you move strategically now, you can lock in the last of those favorable terms.
Okay, let's unpack that shift in leverage. It feels a bit counterintuitive, especially with recent headlines about high vacancy. What's fundamentally driving this reversal?
It's pure supply contraction. And it's all driven by the capital markets.
The money.
The money. The simple reality is that the new development pipeline is just shrinking drastically. Our sources are showing new construction starts are at their lowest point in 5 years.
And that's not because there's a lack of demand from users, right? This is the cost of capital.
Precisely. High capital costs, so higher interest rates for construction loans, much stricter lending standards. It's choked off the ability for developers to launch new spec projects.
If they can't make the numbers work, they just don't start.
They don't break ground. And that delay means the pipeline that we're seeing delivered in 2024, maybe early 2025, it's going to dry up completely in 2026.
So how quickly does that translate into, fewer buildings coming online? When does the market truly start to feel that squeeze?
Well, we're feeling the contraction now, but the delivery impact is always delayed. That drop in new starts guarantees a much tighter supply environment through 2026, and I'd say well into 2027.
Which changes the strategic play immediately.
It does. If you have a plan for a future build-to-suit or some large development, you really can't afford to wait.
You have to control the land now. But let's be specific for the listener. We're not just talking about any piece of raw land. Our sources really emphasize fully entitled, shovel-ready land. Why is that distinction so critical?
Because that distinction is the difference between years of delay and immediate action. Raw land might look cheap, but the whole process of getting entitlement, zoning approval, environmental sign-offs, utility permits, it is long, it's complex, and frankly, it's risky.
You're just buying yourself a headache.
A huge one. But if you secure land that is already entitled, permitted, ready for a shovel, you leapfrog that entire pipeline bottleneck. The land play becomes front-loaded, and that scarcity premium is about to hit hard.
Noted. Buy the land before the scarcity hits, especially the land with the regulatory homework already done. Now let's move into the numbers. This is where the story gets really interesting. The overall market vacancy is projected to tighten to about 8.5% by the end of 2026. On its face, that sounds like a healthy, stabilizing market.
It does. But that 8.5% is the classic misleading metric. You absolutely must look beneath the hood. The vacancy is highly concentrated, which tells you less about the overall market and more about specific subclasses that are struggling.
Okay, so tell us about that disparity. Where's the vacancy concentrated, and what does that mean for an investment strategy?
It's all in the big box properties. We're talking those massive logistics centers, 500,000 square feet and up. Their vacancy is still stubbornly high, sitting in that 14 to 17% range.
That's where the supply surge really hit.
That's where it hit.
So if you're a big institutional fund or a well-capitalized PE group looking for scale, big box is still on a pretty significant discount. But isn't that high vacancy rate a huge potential liability?
That's the fundamental question you have to ask. The discount exists because the market is waiting for those massive users. Think Amazon, a major retailer, to come in and absorb that space.
The risk is real then.
The risk is real, but the opportunity is to buy discounted, brand new Class A shell space, often in premium locations. You're making a bet that the supply contraction cycle guarantees those spaces will be absorbed in the next 18 to 24 months.
So that's the value add play. Now, flip that for us. On the stable cash flow side, where is the really critical demand?
That's in the flex and small bay markets.
Wow.
Properties typically under 50,000 square feet. This market is just critically tight. We're seeing vacancy under 3.0%.
Wow.
It confirms that local demand serving smaller distribution, light manufacturing, final mile, it never really slowed down.
It's the backbone of the local economy. Okay, let's talk capital markets. The great cap rate reset. What's the investment moment look like right now?
Well, the median sold cap rate for Indy Industrial is sitting around 7.3%.
Yeah.
If you connect that to the big picture, that rate is dramatically higher than the, 4 to 5% range we saw in 2021 and 2022.
Which translates directly into softer prices relative to income. So it's a clear entry point. But who's selling at 7.3% and who is buying?
The sellers are often legacy holders or maybe institutional funds that are facing liquidity deadlines. They need to rebalance, so they're willing to transact.
And the buyers.
The buyers best positioned to capitalize are agile, private equity, and private investors. They can move quickly, they aren't held back by massive, sluggish review boards, so they can execute while this window is still open.
Before those cap rates potentially compress again in 2027.
Exactly. It favors speed.
So last on metrics. Industrial is always seen as a great inflation hedge. Is Indy supporting that thesis?
Absolutely. The average asking rent is hovering right around $10 a square foot. And we're forecasting moderate growth, maybe 4 to 6% annually.
And that's a strong hedge because replacement costs are still so high.
It's the key. If it costs significantly more to build a new warehouse today, your existing rents are insulated. They're basically compelled to move upward.
Okay, so the picture is clear. Supply tightening, attractive cap rates, stable rents. But if we only look at today's fundamentals, we miss the future. And this takes us to what I think is the most critical part of this deep dive: power and automation.
This is where the conversation really shifts from geography and metrics to technology and engineering. What's so fascinating is that the industrial user's priority list is fundamentally changing.
It's not just about dock doors anymore.
Not at all. It's not about immediate access to I-70. Future industrial value is tied directly to energy capacity, specifically megawatts per square foot.
Megawatts per square foot. So how do we actually define that in the context of a warehouse? What's driving this serious demand for power?
It means you're moving way beyond simple 120-volt service. The building has to have dedicated, robust infrastructure. We're talking on-site substations, specialized feeders, things that can handle heavy, continuous high-draw operations.
Driven by what? Advanced manufacturing?
That massive on-site battery storage, and critically, next-generation robotics. You need an incredible amount of power to charge, operate, and cool the data centers you need to run a fully automated warehouse.
And this demand connects directly to major corporate anchors, which drives that long-term appreciation. Our sources point to the development around the Eli Lilly Lee Bay district.
It's a perfect case study. The Bay district isn't just a few new buildings, it's a massive long-term infrastructure play for R&D and manufacturing. Any industrial property nearby that is truly power-ready is poised for enormous appreciation.
Because they can meet the demands of those highest value users.
Exactly.
So if power is trend one, trend two is automation. And they're obviously linked. Every logistics company is racing to automate. How does it translate into non-negotiable real estate criteria?
It translates into physical limitations that define whether a building is viable or not. For modern investors, you have to prioritize buildings that can actually handle next-gen robotics.
So what does that mean physically?
It means two specific non-negotiable requirements: 40-foot plus clear heights and extremely heavy floor loads.
40 feet clear. That's the new baseline. Why can't a company make do with the old standard of, say, 32 feet?
It's the automation systems themselves. You need the vertical space for taller racking, which increases density, but also for the machinery. Robotics, sorting mezzanines, all that specialized equipment needs the extra 8 feet for installation, for operation, for maintenance.
32 feet used to be Class A.
And today, it's increasingly insufficient. And the floor loads are just as critical. You need a foundation that can support the weight of high-density storage, plus heavy robotic fleets.
This raises a really crucial question about risk for the existing inventory. If a building doesn't have that 40-foot clear height or the power capacity,
then it risks becoming what we call a stranded asset. And we have to be explicit about this warning. Older big box buildings that lack these specs, they risk obsolescence.
Because they cap a tenant's efficiency gains.
That's it. If a third-party logistics provider wants to invest $1 billion in robotics, they simply cannot choose a facility that limits their technological ceiling.
So the lack of advanced infrastructure isn't an inconvenience, it's a complete barrier to entry for the top tenants. The investment mandate has shifted from find a good building to find a technology-ready building.
You're investing in future capability, not just present income.
Okay, let's apply this thinking geographically. Let's get into the submarket investment playbook. You've broken down the Indy area into specific geostrategies.
Right. We have 3 distinct plays, each balancing the current supply with those future demand drivers.
Let's start with the one most familiar to the big institutional investors.
That would be West Hendricks County, Plainfield, Avon. We call this the institutional core. It's the established heart of the logistics network, right near the airport, and the I-70, I-74 junction.
So what's the play there?
You're seeking moderate, predictable rent growth. The competition is intense, but the certainty of location makes it the safest bet. You're not looking for massive upside. You're looking for stability.
Predictable returns in the core. Okay, where's the high upside, discounted entry play that capitalizes on that recent supply surge?
For that, you go to the East submarket, specifically the Mint Comfort Corridor. This is the value-add opportunity. This area saw some of the highest speculative development, so there's more available shell space today.
So the strategy is just to capitalize on that temporary oversupply.
Precisely. You target recently delivered shell space for a discounted entry price. Then, as absorption accelerates in 2026, you capture significant rent growth. The risk is you need patience, but the return potential is high.
Makes sense. Finally, let's go back to our highest performing asset class, those smaller, stable properties. Where do we find that high demand niche geographically?
That takes us north and northwest. So areas like Whitestown and Zionsville, this is what we're calling the high demand niche submarket. The area is just seeing tremendous residential and commercial expansion.
And the investment focus there?
It should be overwhelmingly on flex and light industrial, those under 50,000 square foot properties. This strategy aligns perfectly with what we said earlier about those small bay properties having vacancy under 3.0%.
So you're targeting the product type that's already supply constrained in the geography with the most growth.
Right. The risk is high competition to acquire them, but the reward is reliable long-term cash flow.
This deep dive has provided a remarkably clear roadmap. It's all defined by timing and technology. So, to summarize the critical takeaways for anyone planning their 2026 strategy.
The biggest returns in the Indy industrial market will be realized by those who move decisively in the next 12 months. The market is shifting from a buyer's lease market back to a tightening supply market.
And that strategic focus has to shift.
It must. It has to be on securing assets that meet the new criteria for automation and power 40-foot plus clear heights and high megawatts per square foot capacity.
That decisive action is the key before leverage completely shifts back to the sellers. If you're sitting on the sidelines, that opportunity created by the supply surge and the cap rate reset is, well, it's dwindling fast. You have to future-proof your assets.
Indeed. The market dynamics are accelerating the obsolescence curve for industrial real estate far faster than in previous cycles.
And that leads us to our final thought for you to mull over. Considering the rising importance of megawatts per square foot and the required specs for robotics, how quickly will the lack of advanced infrastructure turn previously stable, older big-box industrial buildings, those 32-foot clear height properties, into obsolete, uncompetitive assets?
The stranded asset risk is no longer theoretical. It's an immediate pricing factor. Something to think about as you plan your 2026 strategy and differentiate between a discount and a long-term liability.
Thank you for diving deep with us. We'll catch you on the next deep dive.